Hi friends, now we can discuss the basic terms capital, rate of return, equilibrium price of future goods, and net present value in connection with the topic intertemporal choice and capital decisions. As we know, capital is the man made asset which is used for the production of goods and services. Example machines, tools, buildings, etc. is a broad term that can describe anything that confers value or benefit to its owner, such as a factory and its machinery, the financial asset of a business or an individual, intellectual property like patents. This table shows three forms of capital and the respective remuneration given to the owner of such capital. Physical capital like building and machines will get rent as remuneration. The financial capital like equity shares and bonds will get dividend and interests as remunerations. Now, intellectual capital like patent right and copyright, its owner will get royalty as the remuneration. Now, an important term capital accumulation. It refers to the increase in the stock of capital goods. The level of capital accumulation, which determines the level of growth of income or output of a particular person or the economy as a whole. Therefore, capital accumulation is crucial in connection with the growth of output or income. The goal is to increase the value of an initial investment as a return on investment, whether that is through appreciation to the capital goods, rent, capital gains, or interests. It primarily focuses on the growth of existing wealth through the investment of earned profits and savings. Present sacrifice for future gain is the essential aspect of capital accumulation. That is, for making investment or for making a capital accumulation, some sort of consumption has to be sacrificed. Then the person can save more. That saving will lead to the higher investment. Thus, present sacrifice for future gain is the essential aspect of capital accumulation. Now, rate of return. Rate of return from capital accumulation. Generally, rate of return implies the ratio between change in the value of a variable to its initial value. It can be written as R is equal to delta Y by delta I, that is change in income divided by change in investment. In the graph, capital accumulation is shown for a single as a single period rate of return. In the graph, x-axis measures time and y-axis measures consumption. And C0 represents the level of consumption. The level of consumption is horizontal to x-axis except at the points T1 and T2 and again at T3. That is, at the point T1, some sort of consumption is sacrificed for making investment. That is represented by S. And at the point, at the time T2, it is reinvested, and that will lead to increase in income and consumption. Consumption increases by the amount X. Again, at the point T3, it remains at the initial level C0. Here, a change takes place between the period T1 and T2. So, how much growth takes place is represented by the rate of return. Here, the rate of return can be represented by R is equal to X minus S by S. X represents change in consumption and S represents sacrifice or saving. If X is greater than S, then rate of return to capital accumulation is also positive. Now, rate of return and the price of future good. Its relation can be represented as given here. Suppose there are only two periods, T1 and T2. Then the rate of return can be represented as R is equal to X minus S by S. Here X represents change in output and S represents change in saving or investment. This can be written as X by S is minus 1 equal to R. R is equal to X by S minus 1. That can be written as R is equal to delta C1 by delta C0 minus 1. Again, that can be shown as delta C1 by delta C0 is equal to 1 plus R. Now taking its reciprocal, we will get delta C0 by delta C1 is equal to 1 by 1 plus R. This ratio shows how much current consumption C0 must be forgone if future consumption, that is C1, is to be increased by 1 unit. That is the price of future goods. The price of future good is the quantity of the present goods that must be forgone to increase future consumption by 1 unit. Thus, price of future good P1 is equal to delta C0 by delta C1, that will be equal to 1 by 1 plus R. Now, demand for future goods and intertemporal utility maximization. People demand current goods and future goods. Then, individuals' utility depends on the present and future consumption. That is, utility is the function of current consumption as well as future consumption. Utility is equal to U of C0, C1. Now an individual has to decide how much current wealth W to allocate for these two goods. Wealth not spent on current consumption can be invested at the rate of return or to obtain consumption next period, and then individual maximizes utility. Now intertemporal utility maximization can graphically shown as given below, given here. Here in the diagram, x-axis measures current consumption and y-axis measures future consumption. U0, U1, U2 are indifference curves which measures the level of satisfaction of the people, of the individual. And the downward sloping straight line represents the budget line, that is W by P1, W represents the budget line. The utility is maximized when the budget line is tangent with the highest or the indifference curve. In the figure, the indifference curve U2 tangents with the budget line. The other indifference curves only intersect. The only one indifference curve U2 which becomes tangent to the budget line, which shows the point of maximum utility, that is intertemporal utility maximization point. The determination of equilibrium price of future good can be shown graphically. In the graph, the demand curve and supply curves, that is demand for future goods and supply of future goods are given. The demand for future good is inversely related to the price of future good, and the supply of future good is directly related with the price of future good. Thus, these two curves, demand curve and supply curve, intersect at the point which shows the equilibrium position, and the equilibrium price is P1 star and equilibrium quantity is C1 star. Now, the firm's demand for capital and the rate of return can be explained. In a competitive input market, the demand for an input is given by the marginal revenue product, that is its marginal productivity curve. Since capital is a durable good, its demand depends upon its contribution to production for current period as well as future periods. When a firm decides whether to build a factor or a factory or purchase machines, it must compare the outlays it would have to make now with the additional profit that the new capital will generate in the future. A firm's investment decision thus involves the calculation of the current value of future flows of money. Now the concept of net present value. Since capital goods are durable goods, which helps the production over a period of time, the firms or investors must compare the outlays it would have to make now with the additional profit that the new capital will generate in the future. Thus, present value of future cash flow, that is net present value, helps the investors to decide whether a particular investment is profitable or not. While measuring the net present value, we have to measure the present discounted value. It is because the purchasing power of money changes over the period. There may be increase in the value or decrease in the value, or the value remains at the same. So to consider that, we measure present discounted value. For discounting the value, we generally uses the interest rate or some other rates. The basis of this selection is the opportunity cost of capital. The correct value of discounting rate R is therefore the return that the firm could earn on a similar investment. Interest rate is generally used as a discount rate while measuring the net present value. Suppose the annual rate of interest is R. Then $1 today can be invested to yield 1 plus R dollars a year from now. Then present discounted value of $1 paid 1 year after from now is equal to 1 by 1 plus R dollar today. Similarly, present discounted value of $1 paid after 1 year is equal to 1 by 1 plus R dollars. Present discounted value of $1 paid after 2 years will be equal to 1 by 1 plus R square dollars. Present discounted value of $1 paid after 3 years will be equal to 1 by 1 plus R raised to $3. Present discounted value of $1 paid after n years will be equal to 1 by 1 plus R raised to n dollars. Let the return in a year I be represented by Ri if R is the present real interest rate and if this rate is expected to prevail for the next n years, then the present discounted value of the net revenue flow from the machine or any other capital good to its owner is given by present discounted value is equal to R1 by 1 plus R plus R2 by 1 plus R square plus etc. Rn by 1 plus R raised to n. Real interest rate and nominal interest rate. We know the difference between the real value and nominal value. Nominal price generally includes inflation, but real price is the price net of inflation. The real interest rate is the nominal rate minus the expected rate of inflation. While measuring the net present value, all values, cost, profit, and discount rate should be in real terms to avoid the effect of inflation. Now, we can compare different payment streams on the basis of net present value. Here, two streams of payment are given. Payment stream A will get $100 today, $100 1 year after, and thus total $200. The payment stream B offers $20 today, $100 1 year after, and $100 2 years after. Thus total $220. So to examine which payment stream is better, we have to calculate the present discounted value. Now present discounted value of stream A will be equal to $100 plus $100 by 1 plus R. Present discounted value of stream B will be equal to $20 plus $100 by 1 plus R plus 100 by 1 plus R square dollars. Here R represents the real interest rate. Now we can define the net present value criterion for capital investment decisions. The concept of net present value helps the firms to decide whether a particular capital investment is worthwhile or not, whether a particular investment is profitable or not. Net present value criterion is a rule which states that one should invest if the present value of expected future cash flow from an investment is larger than the cost of investment. Suppose a capital investment costs C dollars and is expected to generate profits over the next 10 years of amounts mu1, mu2, etc. up to mu10, then the net present value can be calculated by using the equation net present value is equal to minus C plus mu1 by 1 plus R plus mu2 by 1 plus R square plus etc. mu10 by 1 plus R raised to 10. Generally, net present value can be measured by using the equation NPV is equal to minus C plus mu1 by 1 plus R plus mu2 by 1 plus R square plus etc. mu n by 1 plus R raised to n. Here n represents the number of periods or number of years. C represents the costs. And the small letter R represents the discount rate. The firm should make investment only if the net benefit is positive, that is NPV greater than 0. Now we can conclude here. Thank you.